Great. Well, thank you very much for putting the paper on the program. This paper is written with Andreas Hackethal at Goethe, Konstantine, his former PhD student, and Tobin Hanspal at WU Vienna. So how people decide to invest is clearly one of the crucial economic decisions that people must face. And if you think about what we tend to study when we study investing, I'd say the first thing that we've been very good at is to kind of build a framework about how people should be making those investment decisions. And then we've also been very good at looking what people are doing and saying they aren't doing that, right? All sorts of mistakes people make, all sorts of suboptimal behaviors. But if you think about kind of those situations, well, a super important question would be, well, how can we get them to actually make better decisions, trade better, make better investments? Now, while it's important, we haven't made much progress in terms of understanding how to actually get investors to change their behavior and improve their trading decisions. So it's a very big problem. In this paper, we're going to take a very focused stab at it. We are going to look at one specific behavior, one specific trading mistake, and ask, can a focused educational intervention actually get people to behave more like we would think they should be behaving based on our theories? Now, what we're going to focus on is the behavioral demand for dividend payouts. Now, we think this is a nice candidate for kind of a simple and focused intervention. First off, the predictions from finance theory are really clear, right? So how should you feel about receiving a dividend payout is, absent some frictions, you should be totally indifferent. There's a $1 dividend, prices drop by $1, you're no richer or poorer from that payout. Bring in some real-world frictions, and most investors probably should want to slightly avoid dividend payments most of the time. Okay, so that's kind of the rational benchmark, but what is it that investors actually think? And so here I could turn to the literature or examples or whatever, but we live in the modern world. So instead, I turned to ChatGPT, and I asked it to make me an image that expresses how normal investors feel about receiving a cash dividend payment from a stock. Now, to be upfront, this was actually the first prompt that I put into ChatGPT, and this was the first image that came out. And if you think about what it was trying to, express, this is clearly not the dividend irrelevance or, tax optimization. What do most investors think? Dividends are great. I want more dividends. Dividends are free money. Who doesn't want more free money? So ChatGPT does lie. So don't just take its word for it. There's a lot of work that I've done with Dave, also that Tobin and Andreas have done, that I think show that there is a big behavioral demand for dividend payouts that seems to be pretty suboptimal. The leading explanation, I would say, is what Dave and I have termed the free dividends fallacy. Basically, people don't understand that when a dividend is paid, the price drops by the amount of the dividend. Now, if you don't realize that happens, well, then dividends are free money, right? You just have an extra dollar. Who doesn't want an extra dollar? So that does seem to be a mistake. It does seem to be widespread, and it's also fairly costly. So if you view this as kind of a disconnected free bit of cash, well, that's house money. You're going to be more likely to spend it, use it in ways you wouldn't otherwise use money. In many cases, it'll result in a higher tax bill. There's big time-varying demand for dividend payouts, so if you are buying a stock for its dividends, it tends to be when a lot of other investors are, and that tends to lead to underperformance of those stocks by a couple of % of a year going forward. Also, there's a lot of suboptimal products that cater to investors with this demand, and those products tend to lead to poor performance and are quite expensive. So there's a mistake, a costly mistake, kind of a theoretical grounding to go back to, and this seems to be a bias that's rooted in ignorance. So maybe if we can teach people about it, they can get better and stop exhibiting it. So what we do is we partner with a large German bank to try to educate investors about how to think about dividends. So we think Germany is an ideal setting to do this. So first off, there was a large German bank that let us mess with their investors. Of course, we were going to run it in Germany, but maybe more practically, in Germany, firms tend to pay dividends once per year at the same time per year during what's known as the dividend season, roughly in May. So there's basically one time period each year where you need to get investors to pay attention if you want them to reinvest those dividends. So this is basically kind of an RCT. The bank randomized investors into a treatment group that received our educational treatment, a placebo group that received the same email, or sorry, a similar email to the treatment group, took kind of a survey but didn't get the educational treatment, and then a zero-touch group who we just didn't get any communication, didn't get anything whatsoever. Our treatment was basically a brief interactive quiz that was covering 3 main points. So first, prices decrease by the amount of the dividend. Next, if you reinvest over a long period of time, you will end up with significantly higher amounts of money. And then finally, if you weren't thinking about selling a little bit of a stock, a homemade dividend, well, you should probably reinvest that dividend because it's basically the same thing. One other note is there are, of course, other theories going on about kind of what people could be doing when it comes to demand for dividend payouts. Maybe you think it's a characteristic that predicts returns. Maybe it's something about minimizing trading costs. Maybe it solves a self-control problem. There are a number of other things, but at the core of all of these is kind of an understanding of Miller-Modigliani, and you're doing more complicated things on top of it. So our intervention should only be influencing this very simple mistake that people are making, and if it has an influence, it suggests that kind of the free dividend fallacy is a big driver of this behavior. Now, we're going to run this intervention. We're going to get to see survey responses, which is great, but more importantly, we're going to get to see actual trading decisions for 3 years subsequent to the experiment. And this is what we find. So this is looking at cumulative reinvestment. To the left, we've got relative to the placebo group. To the right, we've got relative to the zero-touch group. This is looking from the week of investment to about a month afterwards. And basically what we find is that for every euro received, in the pre-period, people in our treatment group really weren't meaningfully reinvesting. And in the post-period, they were reinvesting about 50 cents of that euro. And that's kind of the paper. So in our kind of educational reinvestment treatment, if we look at survey responses, people said that they were going to reinvest more. If we look at actual trading decisions, it seems like people actually did what they were going to do in the survey, and we find that result. We've got 3 dividend seasons that we can look at, so the one we do our treatment and 2 subsequently. And so what we find is a pretty stable effect over those 3 seasons, which suggests maybe this could actually have a long-term influence. Now, of course, there's going to be all sorts of concerns about what's going on here. So was it really the treatment? So we can look at kind of different measures unrelated to trading in terms of what investors learned things from the treatment, because those should be the investors who changed their behaviors. And if we look at who changed their behaviors the most, it was those who were bad at our quiz, those who said they learned a lot. There's also a question of what was learned. So our treatment both said you should think about both said reinvest dividends, but also gave kind of the economic intuition of what was going on. So if you're just blindly following our behavioral ask, well, you should probably just reinvest dividends and nothing else should change. Now, if you've learned that the free dividend fallacy was a mistake, there's other things you might shift on the margin. And what we find is, consistent with kind of removing one reason to hold dividend-paying assets, there's a decrease in the dividend yield of portfolios of those in the treatment group. Lastly, this is going to be the most kind of noisy, if you will, because we're only looking at 3 years of data. But if people are reinvesting more, and they aren't kind of counteracting that by shifting consumption elsewhere, well, this is an actual increase in savings. Again, for 3 years, it's going to be hard to look at it, but we're going to find noisy evidence consistent with an increase in portfolio value for those in our treatment group compared to both the placebo and the zero-touch. And if this is an actual long-term effect of, a percentage or so of savings per year, that could be a significant influence in kind of overall lifetime savings. So I think at the end, we show that it is possible, at least in certain settings, to focus on certain mistakes and get people to actually trade more consistent with our theories. Okay, So what do we actually do? So we're partnering with this German bank. We roughly have all their trades, all their holdings, and kind of what the bank knows, kind of demographics, income, things like that. So our sample are going to be people with a self-directed account who hold at least 100,000 euros and hold at least one DAX firm expected to pay a dividend after our intervention in May or June of 2021. One thing to note with this bank, relative to kind of the American setting, there is no mechanical auto reinvest option. So this is all going to be active decisions. So the bank allocated a bunch of people to the zero-touch placebo and reinvestment. So the placebo and reinvestment treatment, folks got an email. They could click the email, take a survey. If you were in the reinvestment treatment, that survey included the educational intervention. The placebo, it didn't. And then if you completed the survey, you got a 10 euro Amazon gift card. Okay, so this is what the survey actually was. So again, there were some initial questions before you did this, but this was the intervention. First question was just trying to get at, well, what happens to the price of a share just before the dividend is distributed to investors? So no matter what you clicked in terms of an answer, you went to a screen, it gave you the right answer, it explained it a little bit, and then we always ended with a kind of what's the takeaway? What does this mean for investors? Well, here, dividends are not additional income because they come directly from the share price. Just like the pizza slice from the pizza in the picture above, after dividend payouts, investors are typically as rich as before. So if the dividend is distributed, the deposit value decreases. Once the pizza slice is eaten, less remains. So very non-technical, very simple, trying to get a this point across in a way people will understand. So next is we were trying to get the idea of the impact of reinvestment. So the DAX is actually a total return index. If anybody remembers my paper with Dave here a few years ago, that's really rare. So most indices, like in the US, are price indices, but in the DAX, it's a total return. So we basically said, look, the DAX started at 1,000 in 1988. It was currently at about 15,000. If it had been a price index that didn't reinvest dividends, what would be its level today? And so the answer is 6,500. And so what's the takeaway? Well, look, if you had withdrawn and spent all of your dividends from DAX companies since 1988, you would only hold half as much in your portfolios as you would today. And then finally, we were trying to get the idea of a homemade dividend. So we basically introduced the concept and gave, does this make sense type thing. And so what was the takeaway here? Well, look, if you weren't thinking about a partial sale to make a homemade dividend, well, then you should think about reinvesting. Finally, we had a kind of, to sum up, these were the big takeaways. So first, dividends aren't additional income because they come from your share price. If dividends aren't reinvested by the investor, this is the same as a partial sale of shares. So if you want the full benefit from compounding and to get the full performance of your investment, you should reinvest. So a big behavioral ask as well too. Okay, so people took this, then they kind of did the follow-up survey questions, and here are the survey results. So 2020 is what people said they did in the past. 2021 is what they said they were going to do in the next season. Purple is placebo, red is reinvestment. And what you can see is relative to either the bars on the left for reinvestment or the purple bars, that right reinvestment bar has gone up a lot. The people who took our treatment said they were going to be significantly more likely to reinvest. Now, we also asked some other questions about things like, would you want a mutual fund that reinvests dividends? If we had auto reinvest, would you like to have it? And again, people in our treatment said they would like these things. So this is good, but of course with any survey like this, maybe this is what they thought we wanted to hear, and that's what they answered it. Maybe this is exactly what they thought at the time, and they went to bed, and they woke up, and they had totally forgotten about it. And so from here, we're going to turn to actual trading data. We're going to focus on weekly level data, again, covering 4 dividend seasons. 2020 is going to be the year before our intervention. 2021 is when it occurred, and we also see 2022 and 2023. Our left-hand side is just going to be kind of net buys minus sells. Paper goes into details of buys and sells separately and things like that. And then we're going to kind of regress this on our main coefficient of interest is going to be dividends received times were you in our reinvestment treatment times you're in the post period. We're going to have investor fixed effects, time fixed effects. And so basically this is saying how much more in the post period did you reinvest per dollar of dividends received? And this is the graph I started with. So what you can see is, to a first approximation in the first week relative to the placebo, in the week a dividend is received, you're reinvesting about 50 cents more per euro. Going out to a full month, it's about 70 cents. Relative to the zero touch, we're getting lower amounts, about 30 cents over the month. The paper goes into where that variation is coming from. Basically, the placebo group is very noisy, which means as a comparison, it's bumping everything up a bit. But kind of no matter which group we look at, if we look purely within groups, we're finding consistent positive results. Okay. So next question is, well, how persistent is this effect, right? So it seems to be there. It seems to be there on aggregate, but I'd say there's kind of two quite plausible hypotheses. One is this treatment had a big effect early on, and it kind of died off with time. It'd still be interesting, but you might need to kind of think of a way to re-up it on occasion. Or is it fairly consistent? Maybe there was a mistake, people have learned it's a mistake, and we would expect kind of a similar result going forward. So what we find is basically a similar effect over these periods. There's definitely noise as we kind of go to the dividend season level, but you can see there's definitely no evidence of a decrease. Also, so we actually kind of wrote up this paper early on using just the t equals 0 and t+1 dividend season. We were about ready to kind of send it out, start getting it out there, and then we lost access to the data at the bank. Basically, they had a server issue that set back a few months. And so by the time the bank had gotten their servers back online, it was basically time for the third dividend season. And so we kind of tacked on the third dividend season, which is kind of an out-of-sample addition that we hadn't initially planned on. Given technical difficulties, it took long enough. And you can see that third season seems to be very similar to the first two. Okay, now, was this really the intervention? And I think we can test this a few different ways, and the paper is going to talk more about kind of various issues and show you sample balances and all those types of things. But what I'm going to focus on here is thinking about different kind of channels that this could work. And I'd say the key thing is if you're financially sophisticated, if you understand Miller-Modigliani, then your behavior shouldn't change at all here, right? We haven't done anything but explain dividend irrelevance. Well, that's not a surprise if you're a sophisticated investor. Also, if you demand dividends, but for a theory that's not about making this mistake, hedonic editing, self-control, whatever it might be, also kind of your behavior really shouldn't be changing. Now, if this is functioning because it's getting rid of the free dividend fallacy, well, it should be the investors who exhibited the mistake before our treatment who changed their behavior the most. And so we've got a few different measures of that, and we're going to turn to that now. So we asked people, first off, just self-reporting, did you find this informative? Did you learn something new? And at least in survey responses, what you can see is the people on the right who learned the most, who said they learned something new, those are the people who changed their behavior the most in terms of surveys. If we look at actual data, we find a similar pattern. So low literacy are people who are really bad at the quiz. So people who are really bad at the quiz or people who said they learned something new, that's really where the big action is coming from in terms of reinvestment, which is what we would predict if what we're doing is actually managing to educate investors about a mistake. Another question is, what is it that we actually taught these people, right? So you think about what our intervention had. Well, on the one hand, we had kind of basic economic intuition of Miller-Modigliani, and on the other hand, we had a specific behavioral ask, reinvest more. So what did people take away? Did they just reinvest more blindly, or did they learn we're making this mistake related to the free dividends fallacy? Now, if they learned that they were making a mistake, well, this basically decreases a reason that you previously had to hold dividend-paying assets. All else equal, going further, you should probably be less likely to buy dividend-paying stocks. Now, so we're going to basically test that and see, do people change their portfolio yield after our reinvestment treatment? And this isn't something that we asked about in terms of behavior or mentioned. This is something they would be generating themselves. And what we find is, yeah, it seems that they are. So about 20 basis points, so not huge. This is about a 7% decrease from the base rate. And this is bigger in terms of new positions that are purchased. Those are about 32 basis points lower than they were before. So it does seem like people learned there was a mistake they were making and have decreased their demand for dividends in general. Okay, so last question we were trying to get at is, well, what about consumption and savings, right? Because at the end of the day, this is a very narrowly targeted thing. But if what we did is successfully got people to reinvest, but we removed a self-control tool, and now everyone's going to Vegas and getting bankrupt, that probably would not be a good thing. But it is possible. Maybe that's what happens. People are reinvesting, but they're kind of overly consuming elsewhere. Another thing that I'd say would be plausible is, look, we've gotten people to reinvest, but we haven't really changed consumption, right? So people are just shifting where they're kind of extracting their money from. Now, that would be okay. Hopefully there's a bit of a tax benefit. Hopefully people are making better choices in terms of what they invest in. Hopefully they're avoiding those not very good dividend yielding products in financial markets. But overall consumption savings rates are about the same. The last one would be, well, look, if people were basically consuming the dividend because they thought it was free money and they didn't realize that they were kind of eating up their savings, well, maybe they're going to reinvest and just save more. Now, if that's the case, you both get kind of the benefits from number two, but you're also saving, 1%, 1.5% more per year, which over the long run could be substantial. Now, of course, we don't have anything like 40 years of data, and this is a subtle effect, so we can do what we can do. But this is basically looking at portfolio value of the treatment group relative to the placebo group on the left, the zero-touch group on the right. And what you can see is, things seem to kind of weakly be more positive for those in that reinvestment treatment, which is consistent with people actually reinvesting more, not shifting consumption away from things. And again, if this is an actual long-term effect, could be a significant effect on kind of overall savings later in life. Cool, so that's kind of the paper. Again, we tried to do a very simple intervention at a very specific behavior to try to get people to make better decisions, bring things closer to optimal. I think we managed to increase planned reinvestment and survey responses. It seems that we increased actual reinvestment in the field. The evidence seems consistent with kind of an increase in savings as well, too. Now, one thing that is kind of interesting about our setting is this was also beneficial for the bank, right? So everyone kind of wins here. We get investors to trade better, the banks get more money, the academics studying things are happy. So this was a nice situation in that respect. In addition, I do think this serves as kind of a direct test of whether the free dividends fallacy is a big driver of dividend demand, and it does seem like it is. But that curing ignorance of that dividend irrelevance does lead to better behavior and perhaps greater savings. Thank you.